Welcome back. This morning, Commerce Department reported construction spending declined 0.4% for the month of July, following a 0.5% decline in the month of June. Taking a look at the charts, we can see construction spending did in fact decline after a long, steady trend to the upside, peaking out in May, but now registering again a decline for June and now July. Yesterday, or actually a couple days ago, the Schiller Home Price Index was reported. Slight increase, but it definitely looks like it's cooling as well. And these are both home builder numbers. So we are seeing a little bit of a weakness. Taking a look at the numbers themselves, we can see our construction spending was reported at 777,296, below the 178, and prior to that 179. So we definitely see a little bit of a cooling on the construction spending. Now, taking another look at it over here, we can see a 0.39% decline following a 0.5% decline the prior month. That's just over month net change, so to speak. And this is after a long, steady trend to the upside. So the housing industry certainly has been very strong, but now it looks like it's weakening just to an extent. Now, with that said, we can also consider the year-over-year numbers. Now, this is, I think, a much more fair way of looking at the numbers because it compares this July to last July. There are seasonal factors that do affect these numbers from time to time. So we do see an increase from last July, but it's a smaller increase than the June month-over-month numbers, and an even smaller increase in the May month-over-month numbers. So, while we can say, well, housing is typically stronger in July than it is in December, this year-over-year calculation really does portray it in a much more fair light because it compares every July together and every June and so forth together. Now, with that said, we know certainly the stock market has been very weak as of late, and it's important to consider the correlation between the stock market and the bond market. Now, the blue line over here represents the net bond spreads, meaning the spread, the difference between the 30-year maturity and the 20-year maturity, the difference between the 20 and the 10, etc. That has been contracting very much. And again, when the economy is in an optimistic mode, when there's growth out there, traders will tend to pay more for the longer term bonds than the shorter term bonds. And when things are very optimistic, they'll even bid up even higher, the higher yield, so to speak. Now, with that said, the red line are the total bond yields. The red line is moving higher. The red line reflects overall interest rates are rising as a result of course, the Federal Reserve. But the blue line really shows us the optimism, or really the lack thereof, within the economy. If this was a strong economy and the Federal Reserve was raising interest rates, we'd expect to see both lines moving higher. But you remember the big downturn we had in the stock market in June? Well, that's when the bond spreads really collapsed. Now, the red line continues higher, especially as of late, because the Federal Reserve again says we expect higher interest rates. But the blue line has been declining because because interest rates are going higher and causing stocks to be weak, we see bond spreads contracting. Now, taking a little bit of a different view graphically at this, we can see this is on a month-to-month basis. Every one of these charts represents the last day of its respective month. And this shows us, with a very nice kind of picture, what the bond relationship looks like. So on the left-hand side of every chart shows us the shortest term bond. That's the yield for the 1-month bond in January. That's the yield for the 2-month, all the way up to the 30-year. January looks for the most part like a healthy economic condition because as maturities rise, the yield each bond pays goes up. Now, I said almost looks like a healthy market because we can see the 20-year bond is a little bit higher than the 30-year. We should not normally expect to see a decline as we move from left to right, but it's very gradual. So this was maybe a little bit of a precursor as far as what would happen, but it's not a screaming warning signal yet. Moving to February, we see the line continues to slope to the upside, but it flattens out the 3, 5, 7, 10-year maturities. This also is not a normal occurrence. Normally, we'd expect to see a nice smooth line moving higher, but when it flattens out, it means that the higher yielding maturities aren't paying as much as we would expect them to. It really flattens out in March. That's the warning over here. We have virtually the same yield for the 1 year all the way to the 10-year. Continues to play out in the month of April. May looks like it improves to some extent. June really flattens out. Remember, the stock market was weak in June. The bond market will confirm what we see in the stock market. So the June graph really does show us a flat yield curve across. Now, flat yield curves do not continue to exist in the bond market. It's not a natural state for the bond market to be in. So when we have a flattening yield curve, when short and long-term bonds pay nearly the same interest rate, that means it's a signal to us that something soon is going to happen. We don't know if the higher yield bonds will retreat back up or the lower yield bonds will go down, but we'd expect it to move in either case. July, nearly all flat. August, a little bit less of an abrupt angle downwards, but still, it's not a normal condition. And we can see again, as this coincides with the bond yields versus the bond spreads, the blue line represents the spreads. So we see as June, the bond yield, what we just saw above, flattened out, that's when all of these spreads really tightened and that line collapsed. And that's when the total bond yields kind of stayed put for the time being, but then eventually rose to new highs. So if we expect this blue line to go up, you know what we expect? We expect for the month of September, we expect to see, this is a current chart reflecting today, that will certainly change. But we'd expect to see September give us a more diagonal curve starting at the low point on the left-hand side and moving up as we go to the right. However, if we see the opposite take place, if we see the blue line really start to go back down again, maybe if stocks go even lower, then we'd expect to see in the month of September an even more dramatic inverted yield curve. So we can actually watch the bond market on a day-to-day basis, look at the relationships between the 10-year and the 5-year. I think the really big relationship is, between the 30 and the 20 and the 30 and the 10. But also consider, what the shorter term bonds are looking for. Remember, again, when things really started to flatten out in March, we had virtually the same interest rate for the 1 year as we did for the 10-year. So I think that real fat part of the curve between the 1 and 10-year maturities, that oftentimes will give us, our first signal as far as what's to come. We hope this has been helpful. We look forward to seeing you back soon.